Hello and welcome to the latest Insider interview. Our guest today is Ben Rogoff, manager of the Polar Capital Technology Trust. Ben, thank you very much for coming into the studio.
Thanks for having me.
Artificial intelligence, AI, is the hottest investment theme in the world right now. You invest in it, but what exactly is it?
Well, the term artificial intelligence really relates to the idea of computers being able to, I suppose, behave like humans, to be able to think like us, and to be able to perform tasks. The pursuit of what is known as artificial general intelligence has been, I should say, sort of the domain of science fiction. That computers with enough power and data would be able to analyze how a human being behaves across multidisciplines, and replicate, the way that our species behaves. And I think it's fair to say that it's been disappointing, the progress made in AI, really since there was focus on it, post World War II. There have been moments of sort of where it feels that we've made progress, whether it be IBM, beating, I think it was one of the chess grandmasters in the 80s. More recently, we've seen the team at Google DeepMind solve for very narrow fields like the game Go, and others solving for things like poker. So some really exciting advances there, also in protein folding not that long ago. But the excitement right now is to do with something called generative AI, which is a sort of different class of artificial intelligence, based on this thing called a transformer, or a foundation model. They're sort of different names for similar things, which has really changed, profoundly changed the outlook for AI. And again, we can go into greater depth about this, but the excitement right now is about generative AI, ChatGPT, which many of your viewers will have used, and what appears to be a very sudden advance in the pursuit of AI.
And who are the big companies winning in this space? And what are the sectors that you should own if you want to be invested in artificial intelligence?
Well, I think the first thing to say is that the ChatGPT was born out of a not-for-profit, OpenAI, where, again, Microsoft very deftly invested in that company, took a minority stake, a very large minority stake in that company. And so Microsoft has, I suppose, pole position as it relates to software companies, certainly, and cloud companies as it relates to AI, because of that alliance with OpenAI. But there are obviously other cloud companies looking to compete there. Google has its own product, Bard, which is its large language model equivalent to ChatGPT. And there, I think it's obviously looking at the opportunity set associated with AI, but also thinking about the risk to its search business posed by it. But I think if we get deeper than that, the ability to make or allow a computer to be able to analyze, I suppose, all the information on the internet pre-2021, which is what ChatGPT was trained on, requires an awful lot of semiconductors to store, to process. The training process is the way that people describe how a computer is able to learn. That process can cost, I don't know, $100 million, and the primary spend is on chips. So a long time ago, McKinsey talked about how 40 to 50% of the AI value chain could end up going to semiconductor companies. The recent quarter from NVIDIA, which is a very long-term holding of ours, roughly around 7% of the trust today in NAV terms, the guidance that company just gave was the largest upside surprise in the history of the semiconductor industry, which really gives you a very strong sense of the excitement around AI and what some people are describing as the AI sort of arms race, as companies across the software piece, but also within cloud, and I you'd like to think really across most sectors in the world, are rushing to understand the risk posed by, but also the opportunities presented by generative AI.
Let's go a bit deeper into chip companies, because they are quite a hard area to get your head around. So NVIDIA, what does that do? What does rival AMD do? What about some of the companies which actually build the chips or sell the equipment used to make the chips? Can we break that down in simple terms?
Yes, we can. I'll do my best. But the nature of the semiconductor food chain is highly complex. But in broad strokes, NVIDIA dominates the graphic processor unit market, the GPU market, which is really the primary semiconductor chip used to train computers to understand, I should put that in inverted commas, the huge data sets that are put their way, and be able to find relationships between words in the case of generative AI. So NVIDIA dominates that market. Right now, most of the spend associated with AI is in the training of compute clusters. And so that's dominated by NVIDIA today. Its rival in the GPU space, I should say, is AMD. Again, a very sizable position for us, one of our biggest active bets in the portfolio, and something we've owned for a very long time, because the company has been taking back market share from Intel in the CPU, which is an adjacent, much larger market today, CPU market from Intel, as the world has gravitated toward the cloud. So AMD has been a big beneficiary of a few things: more stress, the move to sort of chiplet design, but really taking market share from Intel is the kind of punchline in cloud server. So AMD's own aspirations for the training AI market, we'll find out more. They're due to release their new chip, the MI300, at the beginning of next year. So that's the plan there. More broadly, once we've trained these AI clusters, once we've done the training process, then when you go to your desktop, your smartphone, and you ask a question of a large language model like ChatGPT, that's called inference. That market also requires a large amount of semiconductor content. It's estimated, we don't know exactly, but somewhere between $80 to $150 billion market opportunity, much bigger than the training market. And there the competition is going to be, I think, slightly more intense. There will be CPUs, GPUs, ASICs, FPGAs, a panoply of different ways to do that part of the much larger process. So overall, you can see that the opportunity set is large, very large, as it relates to what is already an exciting end market, or the semiconductor market. Not everyone's a player, not everyone's a winner. This is stuff that's happening at the leading edge. So there will be chip companies that don't participate here, that perhaps are lagging edge, or they're, I don't know, analog type companies. So we're most focused on the leading edge and what parts of the manufacturing process become more critical as AI becomes a greater focal point.
Is all the hype about AI justified? Are we going to enter a new industrial revolution linked to artificial intelligence?
Again, I've been doing this for 25 years or thereabouts. And the nature of the beast is that as a tech manager, the hype cycles are almost endemic to our industry. It's how the industry raises capital. Sort of, a great idea explodes onto the scene, and gets some amount of traction, but never quite makes it to mainstream. And in that capital raising process, sort of the sector tends to overpromise and underdeliver. Again, the pandemic has really heightened that dynamic. Lots of things that we as investors, but mostly the world was excited by: home learning, or I don't know, exercise bike in your spare room. That lots of that stuff hasn't really lasted the trip now that we're reopening. So we've had more than our fair share of hype cycles during the sort of last 2 to 3 years. I think investors are naturally skeptical of another one, and here comes AI. So how big could it be? So I studied history at university. We tried to apply historical, I suppose, lessons to the current, to try and make sense really of where we're at. In fact, there were 3 historians in our team of 8, for what it's worth. And I think we all agreed that this is one of those major moments. Like if you went back to ancient history, the development of systems of writing. We went back to ancient Greece, systems for mathematics. These are sort of foundational systems that have allowed humans to codify and disseminate knowledge. Rather than word of mouth or cave paintings. And if you know, more recently, the scientific revolution, and of course in our own lifetimes, the smartphone, the internet, the ability to share knowledge, YouTube videos, how to change a tire of a bike, or news that flows in seconds on Twitter. We've lived through a process like this, but the ability for a computer to be able to ingest all of human knowledge and to be able to answer a question and give a human-like response to a natural language question is incredible. And for me, it's a theme that we have to have exposure to, because I think it does represent a key moment in the technology sector, akin to the internet in the 90s, and more recently the smartphone and the cloud.
You've been running this trust for nearly 2 decades. There's been lots of hype cycles over that period. How do we know this isn't one of those? And what about some of the valuations of Nvidia, for example? It's extremely expensive versus its current earnings. Why do you still own it given its price?
Okay, so firstly, the unfortunate, uncomfortable answer to the question of how can we know that this isn't another hype cycle is we can't. I think that, again, that reminds us that, again, some of the negatives associated with technology, the overpromising and under-delivering, the fact that a lot of things have come and gone and not really left any mark. I don't think that's where we are with AI, but it sort of is a good reminder of why investors, we think, should go down a diversified investment path. If we're wrong, we have a very liquid portfolio of 90 odd stocks, and we can make changes to that portfolio that will hopefully insulate our investors from the worst, if in the event that AI fizzles out again, like it has in the past. I don't think that's what's going to happen here. As for Nvidia and some of the other chip makers that the market's caught on to as beneficiaries, I mean, I saw a statistic the other day that said roughly 75 to 80% of the bill of materials of an AI server are currently accruing to Nvidia. Nvidia is the go-to name in AI because it right now dominates the training AI market. Its forward PE, I think, is somewhere around the 50 point. Again, optically not cheap, I think we can say. We're not selling any. That's not to say I won't sell some tomorrow or the day after. I reserve the right to change my mind, of course. But to date, we've actually only added to that stock. In fact, on the day where the company provided this incredible upside to their Q3 guidance, we added. It felt like a moment when a drug company gets a phase 3 trial through. Something changed. That was the day where the AI story was born, really, in an investment sense. So we've been adding there. We've been adding to other chip companies. We've been looking for new names in Asia. The Asian supply chain looks like a pretty fertile place for us to find less well-trod AI opportunities. So overall valuations have been certainly lifted by excitement around AI. That's true for Nvidia, it's true for AMD, it's true for a number of other companies. But I think, is that unreasonable given what we've just experienced, given that we've just seen generative AI happen? We've just, as consumers, 100 million people used ChatGPT in 2 months. Instagram, which most people have used, 100 million people in 2.5 years. The rate of diffusion is incredible. The scope of what this technology is capable of. I think Goldman Sachs talk about 300 million jobs being potentially at risk, which again isn't a positive thing in a societal human sense, but gives you an idea of the scope and the potential size of disruption represented by AI.
You've got 5% in cash. Is that normal, or are you particularly bullish or bearish at the moment?
Well, candidly, that's about normal for me. We've tended to hold cash in the portfolio, which I think is probably not what one's supposed to do on a textbook investment approach. But I've tended to use cash, particularly when I felt that overall valuations were not cheap. I've in hindsight, wish I'd been more fully invested through my career. But the returns we've generated have been done so without leverage, primarily, and with a little bit of cash drag. That cash is there to provide us with firepower on days of weeks where the market's weak. I think we also use it as a way to ameliorate what is always a portfolio beta well above 1. In other words, the way we construct portfolios, the focus on growth stocks, our view ultimately is that returns should be driven by the growth of our underlying investments, revenues, cash flow, and earnings. And what that means, of course, is that we tend to stay away from companies where they're not growing so fast, or they're value situations or special situations. So the portfolio, through a cycle, we expect to grow faster than the index. That's how we typically would like to be delivering outperformance, but that leaves us with a portfolio beta well above 1.1 times, and I use the cash in order to try to take the sting out of that. Right now, the tech sector relative valuation is reasonably high. It has been a very strong start to the year. We're trading at the high end, if not slightly above, the post-Great Financial Crisis relative range, i.e. the forward PE of the tech sector divided by the forward PE of the S&P. And so with that in mind, and running into earnings season, I think it's not inappropriate to have a little bit of cash.
Finally, the question we ask all of our guests: do you personally invest in the trust?
I absolutely do. So I joined Polar, I think on the 1st of May 2003, and on that day I sold my holding in my existing where I had been working at Aberdeen. I sold that and rotated it into PCT. I've bought obviously more since. It's been 20 years of Polar, and I like to try and invest in either PCT or one of the other technology funds in our stable. We have 3 altogether, as well as a range of other Polar funds. I have a reasonable amount of my net worth in Polar funds, including PCT.
Ben, thank you very much for coming into the studio.
Thank you for having me.
And that's all we've got time for. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.